Hello, everyone, and welcome to another Altos Trading Live strategy session with Jeff Tompkins. This is your host, Richard Van Rich, and with this, we always have Craig Ward in the chat. Really excited to have you guys with us here tonight. Hope you guys had a great holiday weekend and a wonderful 4th of July. Everyone's drank plenty of beer and barbecue, and everyone's got all their fingers. So hope everyone's doing pretty good. I'm really excited to have you guys with us here tonight. Got a lot of great information to go over. If this is your first time on, you'll notice that your microphones are muted. That's how you can hear Jeff and I talk. But there is a Q&A box on the lower hand part of your screen. Click on that, put in any questions there, and we'll get to those throughout the evening and also at the end. If you have to hop off for any reason, don't worry. This is recorded and will be available in the members area later tonight and on YouTube sometime tomorrow. If you have any questions about your account, trade alerts, access to Zillion, Trade Trend, anything like that, email support@altostrading.com. And we'll get to those tomorrow. Before I bring on Jeff, let me just read a disclaimer. Trading securities and options involves risk. Prior to buying and selling an option, an investor must receive a copy of characteristics and risk of standardized options. Investors need a broker to trade securities, and options must meet suitability requirements. Past results are not necessarily indicative of future performance, and performance figures are based on actual trades, including real money results. Due to time-critical nature of trading, broker fees, and activity of other subscribers, there's no guarantee the subscribers will mirror our performance. Performance numbers shown are based on trades users could enter based on the trade signals. All right, with that being said, let's bring the man of the hour up. Jeff, you there?
I'm here.
There you go.
Can you see me? I can't see you.
I can see. Put me on maybe 2, or sometimes you have the. Can you guys see me? Probably it's better I don't see you.
Can you see me?
I can see you fine.
That's so weird.
You look glorious.
Look. I don't know what's going on in my system
looks
here.
like you got some sun.
I did. Been doing a lot of yard work.
Yeah, I'm gonna start having to do that too. Ed says he sees us both.
All right. Well,
Appreciate
I can't see you, but that's okay. As long as you can see me.
So did you fire up the trigger this weekend?
You know, I didn't. We actually went to a friend's for a barbecue. But last time I fired it up, I did the beer can chicken, which is amazing.
Those are so good.
Oh man, it was a crowd pleaser.
Even if you use like just regular old Budweiser, they're still good.
That's what I used. I used a can of Budweiser.
I think some almost like Budweiser is one of the better ones to use. I've used a few others. Didn't quite have the same flavor to it.
Yeah, it does the trick. Man, it was good though.
PBR.
Yeah. So how was everybody's 4th? Put in the chat how you guys celebrated. Hopefully everybody had a good 4th of July Independence Day celebration. Hey Moshi, good to see you on.
Yeah, we were moving, so I didn't have my barbecue grill and stuff out. So I've cheated and went to a place in Atlanta called Fox Brothers, which is like one of the best barbecue you can get. It's like Texas style.
Oh, nice.
Kind of like Franklin's, like
Franklin.
You went to.
Yeah. Man, that's good. Good stuff.
They actually use the same pit. They get their pits from the same place. So
oh, really? That's cool.
A little bit of overlap there.
Right on. Hey, Tam. Barbecue and swim time. It says no COVID infection was a big achievement. Yeah, I agree. I was at the barbecue I went to yesterday. There were our friends. They had a slip and slide in their backyard, so there were a bunch of kids there. So I'm just waiting to see if I get anything. Knock on wood.
My wife's still like hardcore with the mask. Every time we go somewhere, like, wear your mask. I'm like, it's like 96 degrees and humid. I'm like, I just can't do it.
Yeah.
Unless I go inside. I go inside somewhere, maybe. It's like crowded. Otherwise, roll the dice.
Yeah, outdoors is all good. So, all right. Well, looks like everybody had a great 4th. Glad to see that. So we've got some good things to cover tonight. And we'll start out as usual, mapping our levels. And then we're going to go back and review the 36-month moving average that we've been talking about over the last few weeks. A lot of interesting things happening there. and potentially some opportunity might be presenting itself. We're keeping a close eye on it, so I want to continue to follow up with that on our weekly sessions. At a request of a member, we're going to cover trading divergence tonight. We're going to talk a little bit about it. We won't get real in depth because it is a complex technical topic that we could probably do multiple educational sessions on. But we'll touch on kind of what it is, why it's useful, and we actually have an indicator, a proprietary indicator built into our cloud-based Zillion dashboard that measures divergence. And so we'll talk a little bit about that and how it can be used. It is a valuable tool because it, when used correctly, can give us advanced notice of trend changes, shifts in momentum, more so than an indicator might do by itself. And I'll elaborate on that a little bit. And then we'll do our ticker roundtable. Stephen, I'll kind of talk to you about what it is here shortly. Some of you may have heard of Divergence, some not, or maybe you've heard of it but haven't really used it and whatnot. So we'll again elaborate on that, what it is, why it's useful. And again, ticker roundtable, and then wrap up with Q&A. But of course, you guys ask questions along the way. Richard and Craig, again, Craig's in the chat fielding questions as well. And Richard is not shy to interrupt me, and we'll ask any questions that come up along the way. So please don't hesitate. We want this to be interactive. So I'm going to stop my video, and I think I need to refresh to get our data for today. Actually, let's start. I want to look at the, so we're going to look at the S&P. I want to look at the monthly to follow up on the 36-month moving average, which historically has been a really good indicator of turning points following major market sell-offs, bear markets, just general, retracements within bull markets and mean reversion. Has historically been kind of what I would call a value zone for when prices, once they become overextended and reverted back to a 36-month mean, can create some really unique and infrequent buying opportunities that, again, historically tend to be ideal entry points in the market to the long side. And on this particular chart, we're looking at a monthly. So each candle or bar represents a month's worth of trading on the S&P 500, going back 10 years. And if we go back further, like if we go back over 20 years to the late 90s, early 2000s, and the dot-com bubble, since then, so spanning greater than 2 decades, we've had a couple instances where the markets traded below and closed below on a monthly basis, below the 36-period moving average or 36-month moving average, and stayed down there, for a while before they rebounded. But they didn't go too far below, and they didn't stay down for too long. So even in some of the worst situations we've encountered in the last couple decades plus, it's been a really good indicator of mean reversion and buying opportunities before the market, rebounded. And we tend to see bigger upside moves from around this 36-month moving average. And over the past decade, we've really encountered it 3 times. So early 2016, you'll see, and you'll notice when we often see reversal candles. meaning that even if it's a bearish month where the close was lower than the high, or the open, I mean, we see buying coming in within the month when price drops below that level. Now, it doesn't always recover back above the 36-month moving average, but it did here 2 consecutive months in early 2016. And then December 2018, we dipped below, and see that also happened again, where, let's see, within the month of December, price traded below the 36-month moving average, and then buyers came in and ended up closing the month above it. And then we got a big reversal in January, right there in 2019, and then a big move. But you'll notice that we get some very smooth, sustained up moves from this level in general. The last time we were down at this level, other than just recently, which was the market crash in early 2020 due to COVID. Similar, we didn't close above the average, but see how far below it traded, and looking at the range of that month, the high and low range, how far down it got. We were trading below 3,000 on the S&P, but buyers still came in and closed the month up significantly off the lows. And then in April, we get the rebound and then the close back above. And in that case, you can see that that there's a parabolic upside move, right? Just really big with very little retracement or moves down. So we got very far away from the mean, the 36-month average. And then, of course, this year we've reverted. And we've been focusing on this so much because last month in June, we retested the 36-month mean. And so this is a crucial month to be watching how the broader indices, the S&P, SPX, the NASDAQ, the INDX, the Dow, the Russell 2000 are reacting to this major moving average. And you'll notice that this month, we're just barely into the month. You'll see that the low from this month in July is almost right at that mean. So obviously, whether it's a self-fulfilling prophecy or it's there's whatever the mathematics behind it are, or emotions or whatever's driving buying behavior, and it is a closely watched. And the reason that I really emphasize this, it is very closely watched, not so much among retail traders. And I would be surprised to learn if any of our members were ever watching the 36-month moving average prior to us talking about it. If you were, kudos, but it's definitely closely watched among institutional buyers. And that's why you'll see in periods of bear markets or market sell-offs or market crashes, a lot of support around this mean. And so even this month, we're seeing a low so far right around that. So what's going to be crucial is determining what happens in July as it relates to the 36-month mean. Is that going to hold? And are we going to get a bullish close off of it? If so, I think that holds more promise for potentially getting out of the bear market territory across all the major indices by the end of the year. Doesn't mean we're going to close positive on the year. I think that's more unlikely. But what we really want to watch for in terms of gauging whether the bear market is going to extend itself beyond the first half of 2022. We've been in this for 6 months in the sell-off, at least from peak to trough, not in the bear market necessarily, but we're in a situation where we can use that to determine the likelihood of this reversing, at least back to the upside where we have some sustained rally, whether it's what would be termed a bear market rally. So we're still in a bear, overall bear market, but we're sustaining some degree of an up move over across major assets and asset classes. Or if we close below the 36 period, and this is why this is I think so important, is that we're testing this right now, but we haven't closed below it. And again, the one time we closed below it in the last decade was the COVID crash in early 2020. And again, I pointed out other times we've traded below it, but not closed. So that happened last month in June. And if we do get a close below, then we're going to want to start referencing circumstances like 2008 and the housing bubble, or late 90s, early 2000s .com bubble, to kind of look at how the markets reacted to such dire circumstances, which I think most would agree we're in right now. And then we can reassess and readjust based on that if it happens. But so far, there are buyers coming in right now at these levels. So we're going to zoom in a little bit here off the monthly chart into a daily and look at those levels. And I'll show you the really the key one short term that I'm watching for indication of whether I think that this 36-month moving average will hold in the month of July. So I'm going to go ahead and get over to our Zillion dashboard. I got Tesla up. Actually, I want to come back to Tesla. I'm going to talk a little bit, use that to talk a little bit about Divergence Cloud. Let's actually go over here to okay, so on the close today on the S&P, now we're looking at a daily chart, 38, 31, 39. So we're nearing a major level or zone of resistance, and it's a half century mark at 38.50. And again, more of a zone, so it doesn't have to be an exact touch at 38.50. But we're looking for a break of this level. And if we can get a sustained break of 38.50, the resistance zone that surrounds this here, and look back in March of last year, the move off that level, even in the midst of this year's sell-off, we found a fair amount of support there, and 300-point rebound, 300-plus point rebound on the S&P off this level. Broken last month, came back up, retested, sold off again, and now we're still trading below, but we're coming up on this resistance zone. So if we can see some sustained closes above 38.50, then the likelihood of seeing that monthly close in July at the end of this month above that 36-period moving average, 36-month moving average, I think will become greater. But we need to see the S&P stay above 38.50 because it's such a strong area of resistance. And it's not a guarantee if we stay above it that we won't close back below, but I think drastically increases the likelihood of all of those things that we've talked about. So that's the immediate one that we're watching for this week, because it's in play. It's in close to today's close, first trading day of the week, 38, 31, 39. We're coming up on 38.50. We had a lot of bullish action today There's some talk of, too much Fed aggressiveness with rate hikes, and that they could potentially scale back a little bit from what they have talked about to, lessen the likelihood of a recession, which now is kind of a hot topic. Are we already in one? Or, and all the talking heads are kind of like, conversing about the technical definition of the recession, two consecutive quarters of negative GDP growth, or people like to use their own metrics to define that, but it's the big topic and the big concern right now. And are we going to go into that? And the only way really to at least slide into it a little easier, or lessen the burden of going through such dramatic rate hike or inflation, is to scale back on the rate hikes. So that might be the catalyst that can allow that 36-month mean or average to hold, and for the market to move off of it and even maybe out of bear market territory, or the opposite. And if it doesn't, and we do go into recession, then the bear market is likely going to extend. And so, to emphasize, that's why these levels are so important. That's why these averages are important in the context of the overall geopolitical landscape. And so this is the one to watch for right now on the S&P, 3850. Okay. And what I want to see is a close above 3850, not just one, preferably two or three more, and closes with a lot of conviction, which we had today. So I want to see enough buyers come in to close these daily bars near the high, like we did today. So today we had a gap down. We started the month positive on a positive note last week, but then gap down over the weekend due to futures trading lower because of recession fears, right? And even though we actually traded down below the low of last week, or I should say the close of last Friday, their buyers still came in, and it was right off a half century mark at 3750, right there. And you can see what's happening here at this half century mark, 3750. See 3 days. There's selling pressure into that level, and then buyers are coming in. So that's bullish. And then the last 2 trading days, today and last Friday, we got very bullish closes with a lot of conviction. Close near the high of the range. So watch 3850. I want to see multiple closes with conviction above 3850, and even if we can move past that, even in the 39, because 39 is going to be a resistance zone if we can break through. So century mark, but if we can stay above 3050, even if we come down and retest, that's a good sign. And then, personally, I may even go look at starting to buy some broader based index products, whether like index ETFs, SPY IQs, might be a buying opportunity. But I would do it cautiously and with low allocations and protection. So these are the levels I think that are important now for this week. We've seemed to have formed a pretty strong base around 3650. But certainly if something, catastrophic happens and we retest or get near that level before next Tuesday, that's one to watch for support. But also 3750, as I mentioned. And again, another reason technically this is a good sign for the bulls over the past few trading days where we're getting support at this level and having it hold is because of of the move off that level the last time that served as support. And you can see there back in 2021, March. All right, so let's look at the NASDAQ. And we'll use the ETF, the Qs, NASDAQ 100. I was actually kind of surprised this morning when I looked at the markets that the NASDAQ was, closer to the open, was outperforming the S&P and the Dow. And so sometimes tech can be a good leader of the major indices. When you see a divergence between the S&P, the Dow against the NASDAQ, it's kind of interesting, and especially in these types of circumstances. So it could be the NASDAQ is telling us something here. We got more bullish conviction today, wider range. So there's more buyers coming in, because if you look at the ranges over the past few days, and it was surrounding Independence Day holiday, so take that into consideration. But we've got a range expansion. So there's more volatility, more buyers, but we got to close near the high. And we broke through resistance right around 285. We talked about this level last week on the Qs, so 285, and see the the test of that as support from back in May, and that's a bullish indicator as well. 285. So that's one I was watching up until, I'm still going to watch it now for support, but it was resistance today that I was monitoring, and it's broken. So within by the end of this week, certainly within the next couple of days, and it's a short trading week, I think we'll have a good idea of whether this is a false break of this 285 on the Qs, or it's going to sustain. So I want to see a couple more closes this week above 285, perhaps a retest with rejection, and then a move up. Because if we look at if we run the same analysis with the 36-month moving average on the NASDAQ or on the Qs, the NASDAQ 100 ETF, then we're below. So we got to close below on that. So just look at that real quick, which is still NDX. So see how we close below, but we're moving up back. So July. So I need to be a little more patient with the NASDAQ. I want to see for follow through confirmation. I want to see close above 36-month moving average. Same on the Qs here. Right. So we are trading below. We did get a close below, but I want to see what happens in July before getting back into tech. If we get a close above there for any potential long considerations there. So let's take a look at the VIX real quick. Remember, the VIX gives us a lot of clues about what the major indices and overall markets may do within the next 30 days. Measures implied volatility and is inversely correlated to S&P 500 index. So again, in prior weeks, we talk a lot about this resistance zone that late last year and all of 2022 has continued to serve as resistance. And anytime we see continued selling in the major indices, the broader markets, we see the VIX spike up into this zone and then come back down, and we see some degree of a rebound. And right now, we're trading at 27.54 on the close, coming off of that resistance zone. So We've got a lot of support in the 24 to 25 zone on the VIX, or we'll just say 24 to 26 support zone. So in combination, so how am I using the VIX right now? I'm using it to see in the context of the markets moving off that 36-month moving average, can the VIX get back below this zone, this support zone right here? If I start seeing closes below the support zone on the VIX and continued buying on the S&P and other major indices, and that 36-month moving average holding, that would be my indicator that I would start to make some moves to personally, to maybe start buying in to some index products with the expectation that we will get some degree of a rebound when that happens. So that's the major support zone on the VIX. The resistance is up here. And right now we're just kind of bouncing around there, but volatility remains elevated. Conditions are likely to remain challenging until we can get sustained VIX closes definitely below this support zone, but down in this area, and especially down below 20. All right, so I'm going to pause there and see if there are any questions, Richard, and then we'll start looking a little bit about divergence and how it can be helpful to us, some tools that we can use, and then we'll open it up to ticker roundtable.
All right, let's see. I don't have anything specifically about what you just covered. Boris had kind of a question that's related to the market. I don't know if you want to save it towards the end.
Yeah, so Boris is asking, how do you think the excess liquidity of a COVID rescue plan will have to work itself out of the equity market? So I don't think that that is really factored in as much at this point. I think there are bigger issues on the agenda with inflation, rate hikes that are overshadowing anything there. I would be surprised if it has any major impact on the markets. I think it certainly could economically, but always remember the stock market's not the economy. And to emphasize that, remember back, if you guys were investing or in the markets or trading back in 2008 in the housing bubble, probably most people, everybody, lived in a house or an apartment. Maybe you didn't own it, but it impacted everything real estate wise. And the market, the stock market, obviously reacted to that. It lost over 50% of its value in the second half of 2008. Huge sell-off. But that only lasted for 6 months before the market rebounded. So the housing crisis was much longer lived, right? That whole thing impacted the economy for a long period of time. And we're probably still, we've been in a really strong housing market, but it took a long time to get out of that, years. And it changed a lot of things, as it relates to, lending and, down payments and all these things that were impacted by these subprime mortgages in the housing bubble in 2008, but the market didn't mirror that crisis in terms of a timeline. So I think some of these things with COVID and even a recession or high inflation, the market's not going to mirror those exactly. So we could, if we go into a recession, we could be in a recession for a lot longer than the market stays in bear market territory, for instance. So we tend to see the market move a little bit faster. And there's a lot of reasons for that. One being liquidity. Like the stock market is highly liquid. It's easy, with a click of a mouse to get into and out of positions and to start buying. Whereas with a house, that's a highly illiquid asset. And highly illiquid markets move much slower. And the macroeconomy, would be considered an illiquid, measure of things. And that's why a lot of that stuff takes years to play out. Whereas with the stock market, money moves much, much faster. So we often see that as a leading, edge of what's to come. But we also often see the sell-off. I mean, look what happened during COVID, right? It was some degree of a black swan, but a huge sell-off, over 30% on the S&P within less than a month. And we still rebounded and saw unprecedented bull runs and new highs in the market in the midst of all that. So the market, doesn't behave as a reflection of exact reflection of what's going on in the economy. So it might have an impact. I'm not really personally don't consider it a big, thing to worry about in terms of how it's going to impact markets and things. I think that, again, it's been overshadowed by inflation and all these other things. So.
All right, sounds good. I'll make sure I edit some of that out. There's no way a politician can hear that the stock market's not good time.
No, I appreciate that. Probably should have our attorney on here when I do these in case I say anything. Okay, so let's talk a little bit about divergence. Before I forget, I'm going to go back to the Tesla chart. So, so what is divergence? Why is it important? Well, like high level overview and definition of what divergence is. It's basically when, the price of an asset moves in the opposite direction of an indicator. So usually we use like a technical indicator to gauge trend, direction and strength, or momentum, direction and strength. And if they move in opposite of each other, bulk of the time, they will likely move in tandem to some degree. Like that's what the indicators are gauged to assess is the direction or the strength, and they're not always right. But when they are, what becomes a challenge with indicators is that most of them, and probably almost all of them, have lagging components because they can't indicate something to you if they don't know something, and they're using past price. And so some are better than others, some are more timely, some are much more delayed, but virtually all of them are using information from the past. And really the few good ones that are out there use current information and add that to past information to give a better indicator of trend direction and strength. But no matter what indicator it is and how good or bad it is, at some point, it's no longer telling you what it used to, right? So even if it's telling you the trend direction, like let's just use a basic common indicator like the MACD, moving average convergence divergence. And that's a common momentum oscillator that's used for divergence trading. When prices, when the MACD indicator is telling us that the trend in momentum is to the upside, and the indicator is agreeing with that, at some point, because markets don't move in straight lines or in one direction indefinitely, they will reverse. And often because the indicator is lagging, the price reverses before the indicator tells you. And that is very problematic for most traders and investors, because if we're basing trading decisions off the indicator, and it's delayed, nothing's obviously is perfect, but if it's delayed enough that it can't overcome, an edge that you need to make money with your trading strategy, then that's a problem. And so what the philosophy or kind of methodology that was developed to counter that problem, to address it, is divergence. So if an indicator was right and it was telling you the right direction, and or whatever the indicators, whatever information it's designed to give you, it was giving you correct information, then when that information starts to become incorrect, it is often a sign that there's going to be a change in trend or momentum. So it's basically when the price is moving in the opposite direction of what the indicator is telling you. And it's a warning that the current price trend may be weakening. And often when trends or momentum weaken, they reverse, because the reason for that is you have unwinding of directional positions. So like, if you have buyers in the market during an uptrend and they eventually start profit taking, that alone is enough to stall the price and the trend. And especially when you have, sellers coming in and shorting, or in the case of a bear market or downtrend, you have buyers coming in and buying and sellers covering their shorts, then that's what propels price back in the other direction. And one of the best ways to see that before an indicator tells it to you is with divergence, because the price reacts faster than the indicator, and it starts to move before the indicator tells you what the anticipated direction is. So that's, in a nutshell, what divergence is and why it's important, and how we can use it. And and why I said when we started our session tonight that it's complex and you can use it really with any trend or momentum indicator. And we could spend many weekly sessions on it, and we likely will do so in future sessions. It's complex, right? So what we've done is we built, and credit goes to Daniel and his team at tradingindicators.com, brilliant PhD programmer. And he's the proprietary developer of the Divergence Cloud, which is purely a divergence indicator. It's the red and green cloud you see on the chart, and designed specifically for that case. And it's the reason that we combined our trend and momentum indicator, trade trend, on the Zillion platform with the Divergence Cloud indicator, because they are a great combination when you know what to look for. So and the reason I want to come back to the Tesla chart, because when I opened up my Zillion dashboard before we started our session tonight, I had already had Tesla pulled up on my charting. So when I opened it up, it was already there, and I just I knew we were going to be talking about divergence, so I happened to look at it and I was like, oh, this is a great example of that, where we can use a trend and momentum indicator with a divergence cloud. Because the problem with divergence is that there's a lot of discretion involved if you're doing it, from a human perspective. It's hard to be objective and precise about it unless you have an algorithm or a formula built around it. And that's what the Divergence Cloud and the Zillion dashboard does, is that Daniel has developed a divergence formula that creates a cloud on the chart that shows bullish and bearish divergence. So when the cloud's green, divergence is bullish, and when it's red, it's bearish. Now, would I trade purely off of that? Personally, no. Maybe some people would. And trading's complex enough, and there's a lot of variables that maybe one person could do very well just using divergence by itself. But for me, I look for very precise changes in trend and momentum signals from another algorithm, in this case, the trade trend algorithm, during shifts of divergence. So here's an example I spotted as I was starting up the session tonight, where we had a nice buy back on March 17th from our trade trend algorithm, hit the trigger entry price on March 18th, the next day, and then had a nice run up, right? And it was within a bullish divergence cloud, as you can see. So green cloud, and then as we approach not just a horizontal resistance zone up between the 1100 and 1120, well, probably 1100, 1150 static resistance level, we get a shift in the cloud. So the cloud's fading, it's starting to turn to red. And as I run scans, so we actually got a sell warning March 31st on Tesla. That's the white diamond you see here. And it did hit the trigger entry the next day. But what I'm really looking at here is there divergence? Because there was already a big uptrend, right? So divergence, remember, always keep in mind what it's telling us. It's telling us that price is diverging from what the indicator was previously telling us. So prior, it was telling us price was moving up, right? So if price stalls and begins to move down, that is diverging with what the trend and momentum indicator might be telling us. And by the way, the algorithm built into the divergence cloud is not related to the directional indicator trade trend built in. So that's, to me, even a bigger benefit, gives it more power, especially when you spot these types of opportunities. And so price starts to move down, the divergence cloud indicator is red and telling us that there's divergence in trend and momentum from what an actual price action from what the indicator is saying. And why is that the case? Well, if an indicator lags based on past price and price was going up, by the time the indicator might have told us that there's this big sell-off in Tesla, the divergence had already happened way back here. So there's the shift in divergence. And when I use that with the sell on a red, from a shift from green to red cloud, bullish to bearish divergence, or vice versa, red to green, bearish to bullish divergence, that can a lot of times result in really sustained follow through on sell-offs or buying opportunities. So like in this case, Tesla, sell warning, sell trigger, red cloud, huge sell-off. Stock lost almost half of its value. Trading up around 1150. Sells off into the 620 level. So these are where I think divergence opportunities come in, and they're not frequent. You can see there were other selling opportunities that still resulted in nice moves within the divergence. This divergence actually lasted for quite a while, for several months. We're out of it now. We're not in a cloud now. But this bearish divergence lasted for quite a while. We got a couple of sell signals in here. This one was really the best one right here. This one was really the best one if you caught it right on the shift. And then, second best, I guess, as it's selling off into, around the 620 level. And then we start to see things stall. So we're out of divergence. We don't have any divergence happening right now in Tesla. And we're at a horizontal support level. So we want to look for potential bullish divergence now to start taking place as price is stalling and moving sideways. So that's kind of like the rationale behind divergence as it relates to, timing. And in terms of searching for these opportunities, they're built into our Zillion scanner. So you'll see that there's a column in our scanner titled Divergence Cloud. So like if you just pulled up all of our asset classes, we have over 4,800 symbols, and you wanted to, for instance, just look at and using this in the context of what we looked at with our overall market analysis, there might be some bullish divergence happening right now, right? Because we've been in a major market sell-off. Probably all the trend and momentum oscillators are flashing red bearish signals at us right now, but we've already mean reverted. We're starting to move up. And to be clear, I'm not calling like a reversal in the bear market at all. I'm just saying when these types of situations arise, that's how we make the decision whether we look for bullish or bearish divergence. It wouldn't make sense to look for bearish divergence necessarily right now across the board, because we're already in those conditions from way back to early this year. So bullish divergence might be an interesting opportunity to look at. So I can sort that, and it's going to give me, and this is a broad search. I mean, we're looking at all ETFs, NASDAQ, S&P stocks, FX, crypto, cannabis. I mean, I can way narrow this down. I wouldn't do this across all, and you're going to get tons of results. Actually, not a ton. We only got 66 bullish divergence, interestingly. And that's kind of the way divergence works. It takes patience, and you don't get the opportunity a lot. So it's not like a lot of indicators we're going to get just like thrown signals constantly. It's very selective, and that's what I like about it. So I might look in these types of market conditions for bullish divergence to catch maybe some of the early rebounders, and it's going to tell me what those are. And in future sessions, we'll get in more into like historical stats and the trade trend signals and using those. But as I kind of highlighted with that Tesla example, I want to look for bullish divergence in combination with a trade trend buy signal. So we want to use buy signal with divergence because the algorithms they're not correlated. So bullish divergence, green cloud, trade trend buy, or like we looked at with the Tesla example, red divergence cloud with trade trend sell. And that's these columns here. So when I start looking at these, this one's already entered. Like this is Alpha Protect. I don't even know what that is. It's already in a nice buy signal. It's moved. Or Assertio Therapeutics already in a really nice buy. But see how these happen in green divergence clouds? They didn't happen on the shift. But what I want to look for are buy signals that are currents, and we can further filter that here, that are aligning with the divergence cloud. But even if they're not current, these tend to be the kind of my bread and butter opportunities are buy signals within green divergence clouds or red signals within, sell signals within red divergence clouds. So that's kind of what I'm looking for here when I start doing my sorting and filtering. But again, green, we're looking for buy. We can even look at pending. So we only have a couple here, potential pending. I have to do a little more research to see if those are viable.
Jeff, I think it's like, for people that trade divergence, a lot of times you use it as confirmation. It's not always going to be your leading thing you're going to look at. But a lot of times it's so discretionary of what you're looking at, and having something optically pleasing as the divergence cloud itself kind of takes away some of that guesswork a lot of people have. Because, like you said, if you're trading futures and you're looking at the S&P or the E-mini, then you're looking at the NASDAQ, and you might throw in the Dow. There's a little bit of, opinion there or experience to kind of realize what's true divergence or not. Having something as simple as a cloud slapped on the screen in conjunction with trade trend signals is just really super simple.
Yeah, it kind of removes a lot of the discretion and, second guessing and things that we're all subject to when making those types of decisions. So for me, it's a really useful tool. I use it a lot. Um, and so if there are any questions, we can, address those. But I want to leave some little bit of time for a ticker roundtable, and we can use the Divergence Cloud as we look at any symbols people want to look at as well.
There's a couple of people just asked, as if you go back to the screen before that, where it's got all the signals on there, people are asking, what are those numbers within the buy and sell signals are? Like, so when you're looking at the chart, you've got.
Oh, so that's just telling us that how many days the signal's been pending. So these are buy pending. So our trade trend algorithm is designed to give an advanced notice of a buy or a sell entry price. So we've tried to address the lagging problem with indicators by saying, okay, the algorithm anticipates that a particular asset is going to go up or down. So for a buy, obviously up, and the algorithm provides a suggested entry if the asset follows through and starts moving in that direction. So it's a future price that we haven't reached yet. And so what that number is telling us is how many days that since that pending buy signal was issued. And that's the white diamond on the chart. So like here's one on a Certio Therapeutics. There was a buy pending. This one triggered the next day, and that's the confirmed buy entry there on this candle. So that's what that number's telling you. Now the pending ones are good for up to 3 days. So you'll see a 1, 2, or 3. But you can also look at like entries. And so these are going to be ones that were already entered. And that was like the case with that Certio Therapeutics. And it's going to tell you like, just pick one out of here. Some of these are I've got all the assets pulled up. So they're, let's look at this Dorman products. So like Dorman products, you'll see an 8 in the buy entry. So the entry's already happened. So there was the warning on, zoom out here. So the algorithm gave the buy warning on June 22nd, and it would have given you an entry price right around well, you can see it up here, 102.37. That's the price it would have given you to enter to the long side back on June 22nd. And that price was reached the next day on the 23rd. And that is the indicator that occurred. This was a buy on a green divergence cloud. But this is still open as it relates to our algorithm. Our algorithm also gives trailing stops, what are the red horizontal lines here. So this entry was at 102.37. The stock's currently at 112.03. And that's why you're seeing a buy entry that occurred 8 days ago, right? So this has been an open signal for 8 days, open triggered signal. So our sorting allows you to look for signals that were already entered and ones that are currently pending based on, and right, we've got it narrowed down now, right? We're just looking at bullish divergence. So if we took that filter off and we looked for, pending buys, we're going to get a ton of them, right? 357 buy opportunities in our database. And then it'll tell you, again, how many days, whether that just occurred today or how many days in the past that buy pending occurred.
All right. Well, I got a couple tickers popped in.
All right, let's go ahead and start taking some tickers.
How about AMAT?
Applied materials. I haven't looked at applied materials in quite a while. It's taking a hit, down over 50% on the year. So there's not currently any divergence according to our algorithms on AMAT. There was back here early in the year. and it's since dissipated, but there has been a number of sell signals on the way down here. Just got another one yesterday, or not yesterday, sorry, July 1st, Friday, because today's the first trading day of the week. So that was triggered. Got a bit of a reversal here. The thing I'd be looking at is any horizontal support. And I do see some here because back in late 2020, we broke through this level, came back down, retested, and then had a huge move off of it. And this is not a sell signal I would take. I wouldn't take a sell signal in this stage of a move, of a sell-off or move down in a security, and definitely not into a support level that, if you do your homework, you can see that was there from, again, back in late 2020. Sure enough, there was a reversal. So sell signal, I would definitely, ignore. But right now, no divergence happening. So what I'm seeing on AMET is and the biggest thing I'm noticing is this major level of support around 83.50, and the reversal today from a gap down at the open, buyers coming in, pushing price higher, and a bullish close near the high of the range. And from there, I would start looking at resistance levels, right? So we've got a little bit of one to contend with here around the 87 to 87.50 zone. And then from there, there's not a whole lot until we get up to, the 98 to 100 level. So this, in the context of this past strong support, may be a rebound opportunity, but no current divergence happening, and no buy signal. So our algorithms are not at this point spotting this as a real high probability opportunity to the upside. And if anything, there was a sell signal. So I think purely on a price basis, this might, move higher, but on the basis of algorithmic information, I'm not seeing anything telling me, confirming that. So let's take another one.
All right, how about CLX?
Good old Clorox. Who would have thought you could make billions of dollars selling bleach, right? All right, so actually, I want to look at so if there's ever any question on the cloud, oops, I gotta take the filters off. You can reference the scanner. So there's already a buy entry here on Clorox from 10 days ago. It's doing pretty nicely. It was right off is it 125.78. So it's up almost 20 points off the entry, but we're coming out of a cloud. So you see how the red cloud fades. So what I want to look for is I want to see that red cloud disappear, which it did. I don't know if it was right on the entry price or the candle after is pretty close, but if you're ever in doubt, you can reference the scanner, but you can see there's no cloud currently, no red divergence right now, which gives me more of a clear signal to take confidence in a buy signal. Because again, I want to avoid buy signals in a conflicting divergence cloud. So a buy in a red cloud or a sell in a green cloud. And we're not currently in a cloud on Clorox. We got a buy. Let's see if that was off any significant level. looks like there's a little bit of support going back. 2018 around this 120 would have been a little hard to spot, but this is still an open signal. So we want to be looking for resistance. And today, based on price action, sellers did, because if you look at the range, the high and the low, sellers did come in at a resistance area. So, you know, there's our high on the day, but we closed kind of mid-range. And looking at this high, we have a lot of resistance in the past year, right? So price had a lot of trouble, you know, sustaining a break through this level, and eventually finally gave up and sold off. So there is strong resistance, and this is right around the 146. The actual high today was 146.10, so just 10 ticks above the 146 handle. So it's definitely hitting some resistance here. Our algorithm has placed the trailing stop on the close today right there. Which is a ways off from the closing price. That's right around 138.27. And again, if you want to get the exact, you can, oh, it's pretty close, 138.20. You can get it right off the top of the chart there on the dashboard. So that's our stop loss level. But because of the resistance zone, you know, these are, and this is why I look at buying and selling pressure at these price levels, is that if I were, were to take a long position off this one signal, that would be potentially a profit taking area for me. And where I may, shift from using a trailing stop as the trend is and momentum are strong, as it starts to stall, even in the absence of divergence. But certainly if we started to get bullish divergence, then definitely. But yeah, we're at a resistance zone, I think right now in Clorox, and we need to see that really break for a continuation of the up move. But we may see some stalling sideways action or a reversal back down on this one. But nice buy signal there, and right out of that red cloud again. Either want to see a buy out of a red cloud, or from a red to a green cloud, or into a green cloud, or I want to see a sell out of a green cloud, or right into a red cloud, or shift from a red to a green. So that's kind of how that. So that's a good example to look at out there on Clorox.
See, can you look at Halliburton, HAL?
Yeah.
I kind of stole your thunder by telling you the name of the company.
Oh yeah, I knew that one too. HAL. That's an easy one. We've issued recommendations on Halliburton and some of our services. So, all right. So it looks like we're still in. Again, I'm going to confirm here. I think this is in a red cloud. No, it's just out of it. So not just out of the red divergence cloud on Halliburton. Just barely out of it. But you can see like the sell signals are the ones I'd want to be taking in within the red divergence cloud. See how they have bigger moves. And that's why I think it's really beneficial to use divergence with trend and momentum signals or indicators, just to make sure they're aligned. They're going to be your most likely higher probability opportunities. And this was, a really strong sell-off, but it did. Looks like we're kind of getting close to some support here around 27. So I'd be watching the 27 level. So see, there's resistance, support. Right now, we're kind of in no man's land. Coming out of this red divergence, coming into a 27, roughly 27 resistance level. But as I always emphasize, I use more of a zone 26, 28. So I want to see some sort of a reversal off that. We're out of the red cloud. Certainly if we saw a buy signal or a shift to a green cloud, those would be the things I'd be looking for here on Halliburton.
All right.
Let's take one more.
PNM. So Paul, Nancy, Mary.
Not familiar with this one. I actually would not have gotten that. PNM, well, I mean, I guess it's in the name of the company, so, but I did not know that ticker. So I don't know anything about this company. Trying to make the chart look okay. Interesting divergence patterns on this. Like,
I know, it's like you got like these consolidations and expansion and then consolidates kind of in a range.
yeah, like this is actually like this name is an interesting one for divergence because of the way that these, like, if you look at the width of the divergence, like they're very evenly distributed, which of course width is measuring time. And then if you look at like the buy, like when you get it from a red to green, that buy, it also aligns a lot with horizontal support and resistance. Then green to a red, you get the sell. Red to a green, buys. So this is actually an interesting name. I'll have to kind of watch this one a little bit more. To use with combining divergence with trend and momentum, and very rangy stock. This thing just like kind of bounces around in a range for a lot of time. So I'm looking at, so obviously it was in this kind of 50 and a quarter, 46 and 3/4 range for quite a while, broke end of last year, created a new range. The stock just basically ranges around. It's back up in this, but right now, so see that the 48.25 is resistance. See the false break last week, and then last week and today really was the pattern. Close above this resistance, and then rejection back below. So we broke resistance and then came back below, didn't become support. So then, what I look for is move back into support, and there's our major level of support, but also again more of a zone. Get a little more precise with 47. So I'm just looking at major turning points where buyers or sellers came in on a particular day and moved price significantly from that level. And that's why, these are, again, zones. And we've got some significant zoning going on here as price moves back into this zone from this resistance level. And it looks like we're no cloud at the time. No divergence. Right? Did we look at that? PNM? Let's see. Yeah. No divergence. But also did have a nice buy here out of the red divergence. There it is. And I like this one because we're coming out of red divergence, bearish divergence, buy signal. We're at the bottom of the range. To see how like kind of all these things come together to paint a picture and help make a trading decision, right? Coming out of bearish divergence, what is the stock's behavior? It's a ranging stock. It's moving between horizontal boundaries, support and resistance. We get the buy at the lower portion of the boundary, the support range. out of red or bearish divergence. And this one worked out nicely using that analysis back up to the upside. And it's still, by the way, an open signal. The entry was at 46.17. All right, let's go ahead and wrap up with any questions. Thanks for sharing those, guys. Those were fun ones to look at. Any final questions, Richard?
Let's see. Guess I could ask this one. VG wants to know, how did Halliburton have a green cloud for a while and it had a big, large move up?
Yeah, so you can still, so you can still have directional moves without divergence. Remember, divergence is measuring a shift in price that is not in alignment with a trend or momentum indicator algorithm. So if they are in alignment, then you won't have divergence. So they have to be actually in disagreement. And why that's important is because the price tends to give us that information before the indicator, as I explained earlier. And then if we can spot that change in divergence before the directional indicator gives us the red light or green light, and as we kind of looked at on some of those charts, when that happens in combination with each other, that's where we tend to find some really nice opportunities for buying or selling, depending on the divergence direction and the trend and momentum direction. So it's really meant to give us kind of an early indicator of shift, but not necessarily a sustained. But just based on the fact, the way that markets work and trend and momentum works, is you'll still often see green clouds during strong trends, but that at that point doesn't necessarily mean that the green cloud is there because of the strong trend. It just means that there was divergence that created that green divergence cloud. And sometimes it takes a while for that divergence to unwind because it's using lagging information to gauge the directional movement. So kind of a long-winded answer, sorry, but I definitely don't want anyone to think that you can't have an asset move up or down if the cloud is not there. That's definitely not what it's designed for. That's actually what our trade trend indicator is designed for. So you might see buy signals in no cloud or sell signals in no cloud, but the cloud is purely just telling you that the price is not agreeing with the direction, and that's most relevant when it shifts. And as time passes and the asset moves in a direction, it becomes less and less relevant because that divergence will eventually disappear. And again, that's kind of, it's like a hamster wheel. It's like it goes in cycles and circles, but where that becomes crucial is when it shifts.
Good answer. I like it. I see you have a link up there at the bottom.
Yeah. So guys, we again, we'll I'm sure cover divergence more in future sessions. But as I demonstrated tonight, it's in our Zillion cloud-based charting dashboard. And it's a really, really great tool. I believe, and I use it myself. Very valuable. If you want to learn more about it, we put together a class about our Zillion dashboard. There's the link on the screen, and Richard's going to put it in the chat box for you guys. Basically tells you more about the Zillion dashboard if you're not already using it or not a member. If you watch to the end, I'll go through like everything that's included in the dashboard and give some examples of how it works. And then we have a really special package if you want to become a member that is a really good offer and deal for our Inner Altos members. Richard will put that link in the box if you want to learn more about it. And of course, if you have any questions as you're watching it or afterwards, you can email us support@altostrading.com, or give us a call at our toll-free number. So please check that out if you're not already a Zillion member, or you're interested in using the Divergence Cloud on your charts. Our Divergence Cloud is available on all the assets we offer in all the tickers and symbols, and we have futures and crypto and stocks and ETFs and almost 5,000 symbols in our database, and our cloud works on all of those. So if you guys are interested, check that out. Richard put that in the chat for you guys. And want to thank everybody for being here. Short trading week. We'll follow up again next Tuesday. So I look forward to seeing you guys all next Tuesday, 7 p.m. Eastern, same time, same place. And let's continue to watch what happens in the markets, and make sure to bring your tickers and any other topics you guys want to cover next week. And hope you have a great rest of the trading week. Hope you guys all have a relaxing short work week, which is always nice. And we will see you all next Tuesday.